goals and how that makes us more typically successful at doing that. And then with the professional network, we're going to welcome on Amber Saunders, and she's a partner at Nauolo and Saunders and a estate planning expert. So we're going to talk about some of the biggest and most common mistakes she sees and how to make sure you're not somebody making those. So let's jump right into the investment consulting. Got some good stuff going on. So it's really funny. I put this on earlier this month because of the Reddit story that I talked about last month, but didn't have that much data on it. And then I thought when I was going through these slides this week, oh, I wonder if they'll even remember that story or have it as something they care about still. And guess what? The exact same thing's happening again today. So these retail investors are figuring out, a pretty common theme here with these short squeezes. And let's just talk about it this way. People that want the market to go down and people that want the market to go up basically work together to determine the price of, and that seems odd. What I want to get really through your heads when we talk about something like these very fast term fluctuations is there's a few things I don't like as takeaways. One takeaway is I want to try to figure them out. And yeah, they're really fun to look at in hindsight and see what happened, but you're not going to figure out on the front end and things. And in my brain, that makes it even more important to really be a long-term investor, because these short-term fluctuations, just how short-term irrational things can be. And the second is you hear this idea, oh, this, the market's rigged. And it's not. It's a mechanism of price discovery, like any price. So let's say you're selling your house and your house is on the market for $500,000. Well, if somebody offers you $450,000, it doesn't mean your house just dropped $50,000 in value. What it means is you as a seller and them as a buyer are at equilibrium where both of you are price. And that's what's kind of going on here. But basically, if you think about this, the more people that sell these stocks short, once they have to cover those shorts, meaning buy them back because they're going up in value, the faster those stocks shoot up. And that's what we've had going on in this short squeeze. And on a bigger note, here's an example of the last few times this has happened. And if you look at it, this is where you can start to see where after pullbacks, the market actually bottoms. And so one thing you can look at is the reason it bottoms is once you have everybody who wants to sell selling or trying to move it down, then eventually it kind of purges, whatever bad's going on and starts going back up again. So if y'all remember the fourth quarter of 2018, if you look, that was the time the market was down 20%. Look at the short interest versus the long interest. The long interest is up here. Same thing with September 19th. And then look at this March of 2020. So feels like forever ago, but remember what we were doing this time last year. I mean, the recent market highs prior to where we got here were basically last week. It was like February 21st, something like that. And we were all basically starting to shelter in place and at least thinking about that. And coronavirus just seemed so novel and strange. And the market started creating, look at that short interest and look how it's just catapulted up since then. So what I'm saying here is sometimes those pullbacks are an important part of price discovery, but not always bad. And a lot of times when they occur, that shows us our best buying opportunities. All right, and so what are we looking at for the economy for the rest of the year? And this is the same GDP forecast I had last month. Federal Reserve still saying about 5.6%, which is fantastic. But if you subtract from that the 4% we lost, you're still at about, over a 2-year time frame, that 1.7% to 2% GDP growth that we've really had over the last decade. And then with that, though, we're starting to see S&P 500 earnings beats. And that is a great sign because everything prices off of expectations. And when you start to beat those expectations, again, that can be fuel for why things continue to climb and we don't have to have a pullback. And then here's a big one. U.S. manufacturing close to recent level highs. And that's fantastic because as you saw with COVID, it really took a nosedive. And in that time, we really started to have supply shortages in a lot of areas, inventory shortages. And now with this manufacturing, we're starting to keep that up or pick that up. And what this really shows, and this is interesting looking at the of a crisis compared to the Great Recession. So here's how long it took for manufacturing to recover during the Great Recession, more than 60 months. We got back in 12 months. And the difference here is what we had in 08 was a true financial and economic crisis. What we've had here is a healthy economy with a healthcare crisis, but therefore the economy was able to come back quicker. Even though it was a steeper decline initially, come back quicker. And then here's a really cool one, and I'm going to talk about something with home starts in a little bit when we talk what might happen over the next decade on innovation. But home starts, look how up they are for single family and multi-family homes, and especially in the single family home, just significant demand here. And part of what I'm talking about with this, not simply being able to build and get supplies, now that that's loosening up a little bit due to manufacturing picking up, you're able to see these really spike and take off. And then here's the other thing though that goes with that. Because we're building these things, we don't have the right inventories, we're starting to have the price of lumber and materials just shoot through the roof. And we'll talk about inflation a little bit here. I don't think the inflation has anything we need to worry about long-term. I don't view it as something where, oh, we're printing all this money or putting money in the system and therefore prices are going up. It's really more of a supply shortage. And because of that, it'll eventually equal out. But what you're finding is the cost of building, so people are building to meet demand, is far higher now than normal. And that's something that, unless they can raise prices, is probably going to hurt the share price on the home builders, and may make it harder for people to get into homes, but may not if interest rates stay where they are. So that'll be interesting to see. But if you're trying to build something like a deck or a fence, this might not be time financially speaking. And then what that's happening with these supply shortages on things like that is it is pushing up inflation. But again, we think very short-lived as the world kind of normalizes for COVID, not necessarily a long-term threat. And then here's where we're going to talk a little bit about bonds. And we did have a bond question come in, and I want to show something for context on that. And the bond question was really about how long can rates stay low? When will they be able to go down? And one thing in particular, and I'm not going to talk about who sent this in, but happy to talk with them offline, is if you have a large percentage of your bond portfolio or of your portfolio in bonds. And one thing I would like to challenge everybody who has a large percentage of their portfolio in bonds or other more conservative things is to really reflect on why. We are certainly in a time, and maybe 3 to 5 years down the road, it's going to be different, where because rates are so low, the expected rate of return on bond can be a little difficult. And one thing I would advocate is we always own bonds, and I'm just looking up the question to make sure I get it right. We always own bonds for one reason. I'm going to spend my money. And that is a across the board, 100% good reason. And then the way I like to look at that is we do your cash flow projections, money you're spending in 7 years or less. I want to go to bonds or other conservative investments of that type of risk profile. And then I want to have a little bit of contingency money in it as well. However, by the time I start adding more bonds beyond that, what I'm really doing now is behavioral management and risk management, risk tolerance management, not necessarily something I think you logically have to do. And so I would encourage everybody to come to our website who hasn't done this. And let's just go to our website. Right here, Merit Financial, and I'll show you all from the top of it. If you come to our website right here, we have under resources this questionnaire down here. It's Financial DNA. And what this will do is ask you 35 behavioral-based questions and really hone in on risk tolerance and some types of investing bias. And what that can do is figure out, are you a person that really needs to add more fixed income to your portfolio? Because you might lose sleep at night, or you might make bad decisions when markets pull back, or you're someone who can stomach average risk or even possibly more opportunistic stuff. But on the bonds, what you're seeing now, and this is a good sign for future normalization, you are seeing the yield curve pick up. And what that's basically saying is if the market looks out 10 years or more in the future, they think interest rates will eventually be higher than where they are today. Not significantly, but a little bit higher. Certainly on the 30-year treasury, you're seeing that a good bit. But over the next few years, that is not anticipated by the market. So you're looking at, 1 to 2 year bonds, 5-year bonds, really not moving up that much. And so what that'll do is it is healthy when you have that long end of the curve paying more than the low end, but eventually we might end up starting to invest a little bit out there or seeing these lower rates on the low end of the curve start to climb. And one part of the question was, how about on the floating rate side? Where does that come in? Once 10-year treasuries start getting above about 1 to 1.25%, you really start to see those floating rate bonds start to float up and start making some money. So that's our thinking on bonds right now. But I would really go back to the logic of why are you owning the bonds? And then one other investment theme we're starting to see emerge, and this could also, as it emerges more, give places to go in the bond market, but emerging markets are starting to really look attractive from a fundamental standpoint and then also from a valuation standpoint. And here's something really interesting. And when you see this, when you look back and you see things that didn't go up when other things are going up, you can often find better pricing. Here's what emerging markets have done over the last 15 years. They've basically been flat. If you think about that during our time, US markets have soared. How about developed international, such as European stocks? Well, they've basically been flat for 20 years while we're also soaring. And so what you're starting to see now is excellent pricing over there. And then one other thing I would say, and this is something I hear a lot from clients, they're concerned about our debt level and concerned about the national debt and what that might do to our economy. And one thing I would say is, first of all, if you look around the entire world, it's not like we can go over to many places and find people in perfect financial shape right now, but that's another reason to further diversify our investment portfolio around the world and not only keep it US based. And then finally, last on the idea of themes, so much of what we talk about is so short term and based on what's going on now, what we see, there are so many possible surprises on the upside that, for example, when I talk about markets, not being able to keep going up if interest rates go up, well, that might not be true if the right big ideas come along. And so for those of you that are interested in really some future thinking and thinking what might happen in the future on investing or opportunities, this Big Ideas 2021, it's put out by ARK Investments. I would advocate Googling this and just trying to read it a little bit. And it talks about ideas like, what innovation might happen over the next 10 years to help us continue to accelerate and build wealth. And if you think about it, here's at least my belief on wealth and why I like being a long-term investor. I believe there's an infinite amount of wealth in this world. We simply have to find ways to get it. So we often do that through technology. We do that through the discovery of natural resources. I'll give you a great example. The internet is certainly a tool that helps human beings build wealth. Well, guess what? It took us thousands of years to develop the internet. Airline travel and flight, certainly a tool that helps human beings develop wealth. Guess what? Again, it took thousands of years for us to learn how to fly. The telephone, certainly a tool that helps us build wealth. Again, thousands of years before we developed the telephone. And you look at all these things, and this talks about what could happen. So think about this. What could robots be doing for us to help us build wealth? I saw on CNBC today, this is the neatest thing I've seen and not expected. The first home ever fully built by a 3D printer. Can you imagine? All right, so we're talking about the cost of lumber. Well, guess what? I don't have to worry about lumber if I build my house with a 3D printer. And guess what? They can sell those homes at half the price with a higher profit margin to home builders. So now all of a sudden you can help more people get into homes and benefit from them and have more profitable home builders. What else can we build with a 3D printer? How does that change our manufacturing? What about computing speeds? I mean, if you think about, at least my understanding of technology, it's a lot like investing where it's as easy for me to double $100,000 to $200,000 as it is $1 million to $2 million. Well, I think the same is true with computing where they're able to double the speed and then double from there and you get this exponential power going on. Again, more tools for wealth. So this is just a really cool report to talk about some of those big ideas. And I like seeing that because a lot of times when we look out to the future, it's not the things that worked for us in the past that are going to work then. And these will be the companies we invest in the future. One other note on that, Google companies that advertised during Tom Brady's first Super Bowl. You'll see exactly what I meant. Most of them are not around anymore. Okay, so let's get to our advanced planning idea of the day. And before I go to that, Juliana, have we had any questions come in on the chat?
No, I think a lot of just people saying woohoo, but not as of right now. So
this isn't saying it's going to be a straight line. It's not, but it's certainly not going to be the end of the world either. So that's a pretty nice balance, right? All right, so advanced planning. So let's think about the three areas of wealth management that we want to help you with. One, it's the investment consulting and making sure you're investing right. Second, how do we help you in areas outside of that? So tax mitigation and cash flow, estate planning, asset protection, charitable strategies, running your life better. So I'll tell you, one of the hardest things in personal finance is not coming up with good ideas and understanding the logic. It's implementing those ideas and following a discipline. And one thing this article we sent out with this, The Power, Purpose, and Reaching Audacious Goals, talks about is if all you're doing is a goal because you're told to do or you think it's the right thing to do, you're probably not going to succeed. So I don't know how many of you guys had New Year's resolutions, but we're sitting here in the second month of the year. And on average, if you had a New Year's resolution, you're probably not following it still. It works somewhere, till about mid-January and then changes. And when you have purpose behind it and truly put your goals in line with what you care about, we are so much better at achieving them. And one of the things I really like to do is think with the end in mind and then work backwards. And do it in line with something. So I'll give you a great example. What makes you excited about getting up in the morning? I decided when we went into the pandemic, just because of the blah that went with the pandemic, that I was going to try to start exercising more. Well, I quickly learned that I really don't enjoy weightlifting, but I do enjoy yoga. So, I can be successful by getting up and doing yoga, but if I tried to get up and lift weights every day, I would fail. I would not meet that goal. So what do you enjoy doing? And I think about that with jobs that people are successful at. A good example, I know you can make a lot of money being a doctor. Well, I'm not interested enough in human anatomy and that type of science to be a successful doctor. So that just wouldn't work for me. People in my industry who are only in it to make money versus actually loving the content, not as successful. What do you want to do every day you possibly can? Again, back to this idea of thriving because you have more energy to put in it. People on the right seat of the bus build energy on what they're doing. People on the wrong seat of the bus get energy sucked from what they're doing. And then finally, if you want to become wealthy or achieve other goals in life, are you concentrating on those things that create personal wealth? So if you think about this, you might have a goal to retire at a certain age, but what are you doing to really concentrate on getting there? And are you putting in the discipline that will take? And I would say for a lot of you guys who are on the other side of retirement, I think there still needs to be goals. The saddest clients I've ever worked with may have a very successful retirement from a financial perspective, but they don't have that purpose and that reason to progress. And so whether it be a volunteering goal, a legacy goal of helping, educate your children and grandchildren, a, bucket list, always having goals and always having growth will keep you healthy and young. And if you look at them, we need to have an overlap of all these three to really end up reaching our goal. So with that, I will switch on over and we're going to introduce Miss Amber. And I recommend if y'all are doing it to maybe go to speaker view, or actually I'll even stop sharing at this point and we can just have me and Amber, popping up with the heads. It'll be easier. But Amber, to start with, do you want to just give us a little background on who you are and what got you into estate planning?
Good afternoon, everyone. My name, like David said, is Amber Saunders. I'm the managing partner of Nauolo and Saunders, a business and estate planning firm in Dunwoody. So what got me into estate planning? It was an interesting journey, I'd say. I was always going to be a lawyer. I told my mother I was going to be a lawyer when I was 5 years old, but then that's because I excited. I was listening to everyone put in what they're excited about being outside, but I'm excited about being inside because Law and Order is about to come back on and Stabler is coming back, and I'm very excited about it. So now I can watch the new season of Law and Order SVU. So that's what I've done my whole life. I thought I was going to do criminal law, and then I went to court and started crying when a client went to jail and realized it wasn't for me. I needed to find some other type of law. And through me trying business, me trying all of these other things, I settled on estate planning really because of what my family went through. So my grandmother set up her estate plan properly, had safety deposit boxes, healthcare directives, power of attorney, everything done. And then my grandfather apparently decided not to go when she went to do all of these things. And when my grandfather died, there were people coming in the house with Post-it notes and saying this is what he promised them and things like that. And that wasn't the case. And it was just a headache for my mother and my uncle. But then when my grandmother got sick, she had Alzheimer's. My uncle and my mother were able to take care of everything for her. Like there was no issue. They could go to bank accounts and they had policies for her long-term care, disability, everything. Like just, it was so easy for them. And then and she's in Massachusetts, and my mother and my uncle lived here. And so when my grandmother got sick, my uncle went back to Massachusetts to care for her. And then after she passed, he passed about 2 years later. And my mother has been in court for 4 years. And the judge just gave her permission to sell the family house in Massachusetts. So this whole time she's been dealing with creditors, dealing with all of these things, and then finally like having the house with no one in it because she didn't have permission to do anything for all of those years because my uncle didn't learn from my grandmother having everything together. And so he didn't get any plan at all. And so she's had to wait for the court to give her permission to do everything, even though it's all going to go to her anyway. So estate planning is dear to my heart just because I've seen my family go through the good part of it and the bad part of it. And all of those things are really preventable just by, taking some time to do the work up front.
Yeah.
So that's why.
Well, and I would consider a well-crafted estate plan as an audacious goal. If we go back to the idea of audacious goals, and to me, that's one where I have to really visualize the impact it'll have on the people I love. And an example is like the digital assets and things like that, just making sure that's squared away. And that's just a pain. But at the same time, if you visualize what the life's going to be like for the people you love afterwards, you might, achieve that goal versus just going, oh, I can do that tomorrow. Right. But let's talk about, so Amber sent me this really cool piece right here, and I'm just going to read some stuff off and let her finish some sentences, and then we'll go through some key mistakes. And I love how instead of calling them mistakes on this piece, you call them sad day. So you have sad day number 1, sad day number 2. That's a much better way to visualize it, which is important. So first of all, and you just finish these sentences, Amber, estate planning is not about.
It's not about you. Estate planning is about your loved ones.
Okay. Well, you answered the next question, which is, it is about the people you love.
Yeah, it's about the people you love. Yeah.
They'll know whether you lived up to your promise, blank.
When you pass away and they have to deal with whether or not you really took care of them. At that point, they'll know whether or not you actually did.
Cool. And it's one of those things, it's not fun to do, but I tell you what, I always joke with my clients, it's a Murphy thing. If you get it set up, Murphy won't come in, but if you don't do your estate plan, you're probably going to die. So get your estate plan in order, right? All right. So let's do sad day number 1. And you have life insurance left to a minor, or life insurance for a minor, but let's say anything inherited by a minor that's not organized. Tell us about that.
Okay, so minors can't inherit. So even if you want something for the minor, they can't take possession of it as a minor because they're not adults. They can't make decisions. They can't contract. So in the example that I had provided to David, this parent had passed away, but they made the minor child, the beneficiary of the life insurance policy. Well, the child can't take the money because it's a minor. So that means that the proceeds they would have to go through probate court to figure out who's going to be the conservator or the oversee that money for the child until the child becomes 18, and then they can inherit and take the money at that time. So even though the mother, who might be the guardian of the minor child, is still alive, it's not automatic that the parent, the living parent who's left over, would be the financial conservator. It could be some other relative. It's up to the court to decide who they think is the best fit. So if there's one person in particular who you want to be able to oversee things for children or what have you from a financial standpoint, it's better to set that up and to designate how that money is going to be spent or given to the child, so that a third party judge who doesn't necessarily know what you want is not up here deciding after the fact.
Well, and that's pretty hard. So with the third party judge, the living parent would always get custody of the child and always be by default, unless they're unsuitable, the parent, but then the judge would look at, and I would think it would be very hard for a judge to know if that parent should or shouldn't be without looking at all their financial records. How deep did they go on that?
It's really, so another relative of the person who had the life insurance policy can say, hey, well, they were divorced, so I don't think he would want his ex-wife to be insured. So it could be anything. I mean, the judge really doesn't know. Any amount of evidence can be put up. Both sides can petition and say why they should be the person. Now, the funds probably would still go for the care of the child, so that the parent would get some money for that, but they might not have complete oversight over it. So it varies, really. It's a host of factors that the judge might look at to determine what is in the best interest of the child.
Sure. All right, let's go to the other end of it. And that kind of combines sad day number 1 and 2. Let's go to sad day number 3. So, and then I promise we'll end with like happy day.
Happy day.
With all this. Oh, happy day, right? An adult is incapacitated. And I thought about this week with Tiger Woods, and he, certainly wasn't incapacitated and is lucid and able to think and make decisions, it seems like. But, what I thought about with it was, here's this guy who's in close to perfect health, and one car accident put him this close to being an incapacitated adult, right? So tell us about that. When an adult becomes incapacitated, what are some of the fears, and why do we want to make sure, for you guys on this call, you take care of this for yourself, as well as maybe your parents and other people you love?
So a couple things can happen. I'm probably telling my age, but everyone probably remembers Terry Schiavo. So long ago, Terry Schiavo, even though she was married, and every state, their law varies with respect to the decision, but her husband, in the state she was in, I believe her husband had the final say so where she was on what would happen, but she hadn't made a healthcare directive to say what her wishes would have been, how long you can designate, how long you want to be on a machine. You can designate when you want them to pull the plug, all of those things. So because she did not do that, the parents were able to petition the court to say they don't agree with what her husband decided. And she was on that machine for 8 years, appeal after appeal, hospital bill for years and years and years for him to finally be able to pull the plug. But then after that, they have these bills and all of these other things. And of course they're sad because she's gone, but if that's not what she wanted, we would never know because she did not say so. And you can do a healthcare directive that outlines exactly what you would want to happen. And whoever that agent is the person who would be able to direct the medical professionals as to what would be done. But if you want to share with another family member, hey, at least allow them to look at the medical records so that they can see what's going on. If you want them to be involved, you can sign a HIPAA waiver and say which relatives or whom you want to be able to have access to your medical records, because they're not automatically allowed. So it would only be if, for example, you were incapacitated and your spouse had access. Your sister and your brother might not be, they won't give them any information, even though you might want them to be able to see also so that they can be aware of what's going on. Also for your children, if they're going to college, a friend of mine's child is 18 and graduates in May. If something happens to this child right now, they will not be able to get access to that child's medical records because the child is 18 now. So it doesn't matter if they're still in the parent's house. Once they become the age of majority, that information is not automatically able to be given to a parent. So when your children are going off to college or once they become 18, you need to have them sign at least a HIPAA waiver to allow you to have access to the medical records. And if you want to be able to make decisions on their behalf, you're going to have to get some sort of healthcare directive that gives you authority to do that as their parent, because now they're adults.
That is amazing. And when you think about that, an 18, 19-year-old, 20-year-old child going to college, hopefully nothing happens. But what if that person's in a car accident? What if that person gets COVID and it ends up being a bad case of COVID? I mean, wow. That's a service message for a lot of the folks here with grandkids in that age group and a few with children. So one of the things on this sheet you gave me, and let's just talk about this, it says it doesn't matter if you're married. So basically, if you're married, you still have to have these documents. It's not a default thing, correct?
You need to have the documents so that it doesn't cause an argument like it did in the Shivo case. The husband was the one in that instance who should have been able to decide. In some states, your relatives can have say so, but there's one final decision maker. But if she had just outlined it, then there would be nothing to contest. Because they would have to follow what she put on that form, as far as how long to keep the person alive with artificial means, et cetera. So if you don't designate it, then there might be family members who say, hey, we don't agree with this. We want them to stay alive. And then it's going to go through probate court to battle out what needs to be done ultimately.
Mm-hmm. All right. So sad day number 4, and then we'll end with a happy day coming up here after 5. All right, this is about when a parent passes away. And so one thing, I thought this was interesting to say, you said when to blank is decided as a group. Do you remember the answer to that?
Let me look at it now.
Well, it said when to remove life insurance or life support is decided as a group. So
that's the one that I was talking about earlier.
Obviously not something that has to happen, but there seems to be some wisdom behind it. Tell me that.
Yes, so it might be, so for a client that we had recently, we set up a disability panel. So she wanted not just her husband to decide, but she wanted her siblings to also have some input. So before, if she was alive and she was in an accident, before she could be deemed incapacitated and whomever she named, have access to funds to do all of those things, the 3 of them decide together as a group with the input of her physician. So the physicians are listed, but so they can't just say, hey, she's incapacitated and shoo her away. It has to be with input of a physician. I think she might have had a total of 5. So it was like 2 of her doctors, her main physicians that she had, and then 3 relatives who decided whether or not she was incapacitated and really need help, things like that, because she didn't want it to be up to one person. So sometimes it's just better to have, and then we created HIPAA waivers so that those family members would be able to access the medical records and then they could collectively decide. She didn't think it would be a problem because her family gets along, but she didn't want it to be on one person for that to cause resentment. She wanted those people to be able to decide together if it was an emergency situation and something happened to her.
Yeah. Well, and I think it's interesting. The person we had on last month, it was Right at Home Senior Living. And they talked about what do you do when, people want different things in the way of care for a parent. And what's funny is their point was a lot of times it's like the one who's not been there the whole time wants to have this say almost because there's like this type of guilt. And you need to try to relieve that, and keep it in one peaceful terms and just simple, but your wishes too. And then here's a big one I see for a lot of our clients and a few people on this call actually. So what if you have mom and dad pass away and they have real estate in multiple states? Tell us about why that might be a sad day.
Well, because you're going to have to, so I'm of the opinion that if you have real property, the best way and the easiest way for everyone is if you set up a trust. Because if you don't and you have a will and it has to go through probate, then you might be stuck in a situation like my mother, where it takes 4 years for the court to get to the case to help you be able to dispose of the property. You're paying taxes on it. You're having to do all those things and you can't take care of it. And most of the time, if the person, open the probate matter in the county within the state where the person passed away, if the property's in another state, then you have to open up a probate matter there because the real property is there and you have to do it in every single state that the property's in. However, if it's in a trust, and you have a trustee and you have those documents and it's properly recorded and funded into the trust, then the trustee automatically at the time of death has authority to go do what they need to do with the property without having to go to court. So you can skip having to open up the probate matters, pay lawyers, do all of those things in multiple locations.
Okay. And then one other thing is, once you move that into the trust, you're pretty much 100% sure at that point in time who has the deed on the house and how it's titled, which I know it might not sound like much, but we've heard some horror stories. And I actually saw one recently in my life on that, where, oh my gosh, we had no idea that that deed was this way. And it could have been really nasty if things had gone a little bit different. So I'll just share that if you don't mind. My 89-year-old grandmother, we recently sold her house. And so my dad was going to go to closing, and he's a financial advisor too. So it's not like we shouldn't have our house in order. My dad was going to go to closing, and they realized that when my grandfather passed away in 1977, remember, chauvinistic world in 1977, his name was the only one on the deed for the house. Because, back then you didn't put the woman's name on there too, for some people. So technically my grandmother's been living in that house from 1977 till now with her name never on the deed. Luckily, because she's still alive in an assisted living home up in the Johns Creek area, we were able to move that deed to her, and then she was able to sell the house. But if she had died, 89-year-old grandmother with Alzheimer's, and we had not sold this before and not moved it, I have no idea how many years my parents would have been stuck with that house and the estate open. So that's just an example of, you might have some alligators out there that you don't expect. And this stuff is really, complex to know what might be under the hood. Not necessarily, and I guess the area might not be, obviously this issue I'm talking about, it's not really complex. It's just maybe it's not predictable.
Right.
So anyway, that was my story on the house. And then here's one, and this overlaps some cool stuff with what we do for people too. But your young adults and the IRS inherit your money. Sad day number 5. What makes the IRS inherit money?
Well, it depends on, if things change in the amount. So right now, what is it, 11.4 million and up, you'd have to pay estate tax. It might lower to 5, or it might expire at the beginning of 2026. Or was it 2025, David?
It's January 1st, 2026. So you guys are thinking your planning has to be done in 2025.
Right.
In 2026. Yeah.
And so
that's all assets, including life insurance.
Yes.
So you might be below, and I know a lot of folks like this, they might be on the investable assets well below 5 million, but you add back in their life insurance and some real estate, and you might get there quicker than you realize.
And so the IRS is, as we all know, going to come take their cut first. And so even before anyone else gets anything. So in the example that I had given David, it's sad day was in reference to, we keep seeing in the news over and over again. I think the most recent person was Tony Hsieh, the CEO of Zappos, or the ex-CEO of Zappos, passed away without a will. And so I think he was worth $850 million, and the IRS is going to get almost half of that. And then everyone else is filing all of these lawsuits against the estate that they had to create because he didn't have a will, saying he promised me this, or I helped with this. So they're going to be in court for years. And if you Google Prince Rogers Nelson right now, you can see every single document filed in his estate and everything that they're doing, because it's public record when you have to go through probate and things like that. And so what they're trying to raise money to pay the IRS bill before any of the other relatives can inherit what they're supposed to have. So if you're above whatever the threshold is at the time that you pass away, that the IRS, that bill is going to be the first bill of many that has to be paid.
Yeah. And one other inheritance issue with the IRS, and so this is something that changed recently with the Secure Act. It used to be that if people inherited your IRA, they could stretch that out over their lifetime. Now they have to spend that within 10 years. And so one of the things you may want to look at is, if they're having to spend it over 10 years, do you want to leave that money in a regular IRA, or possibly do Roth conversions or things like that, if maybe the parent's in a lower tax bracket than the child? But that puts a lot of a lot of tax burden on people quicker than have it. So, we all want our COVID relief, but we got to pay for our COVID relief too. So,
And that's why when you do an estate plan, it's really important that whoever it is has conversations with your financial advisor as well, because it needs to be an estate plan that encompasses things like that. Like it needs to be a bit more holistic. You can't just go do your financial plan with your wealth advisor and then go do your estate plan separate. They need to know what's going on back and forth so that they can try and build a plan that really works the right way for you when you need it.
yeah. Yeah, absolutely. And, it's funny when it's, heck, I had a situation recently with an estate planning attorney where client of mine that has certain personality quirks, just simply helping her to understand that, like help the client work better with that person. And, that's something that, because so much I think of estate planning, it's a lot of it's the touchy-feely bedside manner stuff. Who do you relate with? How do you do this for the people you love? So how do we then take, sad day and make it into a happy day? Well, y'all have this thing, and I think it's so cool, called the signing ceremony. And then after that, you pop some champagne. So tell us about the signing ceremony.
So the signing ceremony is when we go through everything, where we walk through the entire estate plan. We explain all the provisions. We sign it. And during that ceremony, we schedule legacy interviews, which are optional in our plans. But for us, estate planning is not just about your assets. It's about your values. It's about who you are. It's what you want your family or your loved ones to know about you. So for example, for grandparents, like depending on the age of everyone, like we give different gifts. My father gave me one year, there's a journal, it's called A Father's Legacy, and the parent takes it for a whole year. And so every page in there, he started in January and wrote what about his childhood. In February, the things that he wrote in there were like, what is the first thing he thought when he saw my mother? So I can open up this book and see everything about my father's life, high school pictures, different things. It's a journal to be able to give to family members, because I'm not going to remember necessarily that my father might have left me some money, but I'm going to always have that book to remind me of who my father is and who my parents were and things like that. So we try to invite family members into the signing ceremony, and if they're fiduciaries, explain to them what that means, where things are, so that it's more than just preparing people for death. But I think that when you think about the fact that all of us will leave at one point or another, then we should live our lives differently. We should cherish our loved ones more, and it will start different conversations when you change the conversation about that moment. Uh-oh, I think he froze. Are you there?
All right, you froze right at the end there. So I was looking at it. I wasn't sure if that was my computer or you, but yeah, that was great. So it changed the conversation when you do that. So, all right, well, thank you so much, Amber, for being a part of this. And any questions anybody in the group has for either myself or Amber before we wrap up? So are you guys seeing, showing the wrong page, sorry. All right, Juliana, are y'all seeing my screen now, or are you seeing?
Yes, we are.
Okay, cool. So I'll just come back here. If anybody wants to get in touch with Amber, Juliana can get you that information. You can also go to, what's the website, Amber?
That first word, so if you can't
type it into chat if you want
Nauolo. Okay, type it in the chat.
Yeah.
And send me an email, go back to the QR code. If you want to schedule a meeting with Amber or David, just schedule the QR code and just let me know you want to schedule with whomever, and I will just pass that information along. Wait, give them a couple minutes, please.
All right, definitely. All right, so just to kind of wrap up today, so the three things we covered, investment wise, it certainly a lot going on, but a very consistent message from last month, where starting to have this kind of rotation out of only COVID world into back to a little bit more normal, and thank goodness for that, I think we would all say. And then on the advanced planning side, really, what is the motivation on meeting goals and setting goals that you're going to achieve? Because one, maybe they're big and they're stretch, but they're things you really care about. And so you end up doing that. And, it's not something you're just doing because you feel like you need to do. So you're doing it because it's important to you and how much further you can go. And, you know, I tell you what is amazing about that. If you really look at some of the most successful people in this world, a lot of times it's so much more than money that drive them. And, you know, the money is a nice little side effect, but I mean, look at, you know, Elon Musk and Jeff Bezos and Bill Gates. These guys are all guys that wanted to change the world for the benefit of others, and, you know, money followed. And so, you know, that can be, you know, your path financially, but you can also have it be the thing that helps you be somebody that leaves a great legacy versus dies without money. And, you know, on that legacy front, remember what Amber said, and people like her. One thing I love about Amber and her partner, Sammy, is they do a good job of being a little bit more holistic than just the estate plan. But people like her are there to help. And I'll do a quick plug. We're going to, throughout this year, do a few special webinars outside of this webinar with Amber and her partner. And the first one we're going to do is what are some possible changes post Blue Wave? So what could the estate planning world look like under a Biden administration? Certainly, you know, there's the idea that he might get nothing through. There's the idea that he might do everything he campaigned on. But one of the things we're going to talk about in that workshop that, you know, I'll plug so you'll want to come, is the idea of the OR versus the ER, which is there's not much medical malpractice in the OR, but a lot of mistakes happen in the ER. And the difference is what is planned and what is thought through versus what's an emergency and done as fast as possible. And if we're in a position where, you know, certain laws get passed in November or December of a year, and you need to possibly do something before the end of that calendar year, we want to make sure you're educated to make that decision wisely and not, you know, something knee jerk. And then we might do one on family branding, and then some of the, you know, just other topics type stuff that she was talking about today. So got those coming up. You should see that in late March, early April timeframe. And then besides that, I hope everybody has a blessed month. And if you need anything, please reach out. Thanks, guys.